So what to look for in a market before you invest in multifamily. And the reason we specified it down to multifamily is because it's much different than single family or, single family rental or storage, as we are into storage as well now. There's different metrics that really play into that. And I'm going to go over kind of a little bit of what we do, and then some of the other things that you can look at that are different. There are different investment strategies for this. And I'm going to pull up my chat real quick so I can see any questions. Again, give me a sec because this thing is acting weird. I'm going to get to the questions at the end. So if you're putting in chats, I'll check those at the end. I'm not looking at them right now, so I apologize about that. With a screen share on a single screen. So first of all, we've talked many times about what to look for as far as properties go, what type of assets and asset classes. So we've been over that. And now that you know how to pick what type of asset you're going to look for, you want to know where you're going to buy that asset. So, in the previous webinars, we talked about A, B, and C class properties, the differences between those. So I'm not going to get into that and repeat that. If you miss those, you can go into our archive and get copies of those and watch them on, I think, YouTube. Melissa will put in there where you can get access to those prior webinars. So, but A, B, and C class, different vintage, different door size, different overall price that you're going to select. And then you want to know where to go and look for these properties. So there's different mentalities when it comes to what markets to choose. So when I say market, that's really a city, but you can go bigger and go, what state are you going to purchase in? And even what country, there's some Canadian investing and different things like that, but we're going to focus mainly in the United States. So when purchasing within the United States, you want to select which state you're going to purchase in first. And really, that's a pretty easy one to look at because you want to look at landlord laws overall. So I know in the news, you hear a lot about New York and California and Chicago area, different rules that they have for evictions, and are they landlord friendly? Are they not landlord friendly? So that's a big factor in selecting. I know some great people that are investing in New York and California and the Chicago area, and they're killing it. So it's not to say it can't be done, but that's one main factor that I look at. And then historical economic or population growth. Right now, obviously the Southeast is booming. The Northeast, especially New York and California, you have a big exodus. We've seen in the news, different companies leaving California and Silicon Valley and going to Austin or Dallas, different places like that. So I'm looking at the historical trends of population within the state and where is that growth occurring. And you're going to, as we get into the submarkets, you're going to look more at the income level. But so that's where we start. And then now that you're in a state, so we are in North Carolina, South Carolina, Georgia, and then Florida and Texas. Those are our states. And so within those states, now that we've selected that, and that's because those states house some of the greatest, in our opinion, economic markets or economic cities. So when I say that, I'm saying Charlotte, which is in North Carolina, Raleigh, North Carolina, Atlanta, which is in Georgia, Greenville and Charleston are kind of our South Carolina. They're not really what we would call metros like you would call an Atlanta, a Charlotte, or even a Raleigh. So they would be more considered secondary markets. But we do look there. And then in Texas, it's Dallas, Fort Worth, Houston, Austin. You also have San Antonio. And then within those, you have smaller submarkets as well. Florida is Jacksonville, Tampa, and Orlando, and Fort Myers are the markets that we're looking for there. So how do we come up with that? We're looking, again, at the popularity of the market. And I know that sounds a little bit maybe fickle, but if it's in the news and it's a place to visit and there's publications out about it, it's going to drive population. Take Greenville, South Carolina, for instance. It's top 10 places to visit in the United States, from Reader's Digest and, Southern Living, different places like that. So people all over the country are going to come across Greenville, South Carolina and say, oh, I want to move there. Whereas if you're looking at Florence, South Carolina, or Fayetteville, North Carolina, they're not in any news stories about great place to live. And so you're just not going to have that population boom that you would in something that's making the news. Same thing applies for Austin, Texas, right? I mean, how many of you, I know I can't see you, but raise your hands if you've heard about Austin, Texas in the news. That's a very good thing. There's people, jobs are scarce in the Northeast, but Austin, Tesla's moving to Austin, so I'm going to move there and try to find a job. So that's going to drive population. Industry equals population. So those are things we're looking for. So popularity, PR about a market is very important. Secondly, we're going to look at the what kind of economic factors are driving the economy. Okay, so Houston, probably some of you cringed a little bit when I said Houston because of the oil market and the kind of up in the air nature of the oil market with the new administration. So that's something to take into consideration. And then is the economy of your submarket that you're looking at, is it driven by one sector of the economy? In other words, back before 2008, the crash of 2008, Charlotte, where I am right now, was mainly finance. And so they took a large hit and had a lot of, down economy because of that. They are now diversified and they have finance and tech and manufacturing, different things that have come in, and it's more diversified across economic factors. So it's not all one factor. The other thing to look for is it heavy military or heavy education? I live in Columbia, South Carolina. I do not invest in Columbia, South Carolina. Again, I know a lot of good people that invest in Columbia, South Carolina and are killing it. It's just, I'm sharing why we don't, so that you can take that into consideration, is because it's heavy military, which is transient. It also is affected on who's the president and whether they're building the military or shrinking the military. So when you go into these apartment complexes, a large majority of the residents are military. So if they start cutting back, what's going to happen to your residents? They're going to decline. Same thing with housing with students. So it's not student housing. We're not, renting per bed, but you have a large student population within Columbia, South Carolina. And if something like, COVID hits and everybody's doing virtual and they're no longer renting apartments, you're going to be hurting from an occupancy standpoint. So those are things that we also look for. Another thing with Columbia is it's political because it's the capital. So you have a revolving door there of people and admin and different things based on administration when people come in their term. So you have a lot of rollover there, and there's not a lot of big industry. So that's in South Carolina. So let's shift and look at Greenville. Greenville has Michelin, BMW, the list goes on and on of places. Boeing, I believe, has some there. There's large blue chip, well-known corporations that have a presence there in manufacturing or shipping and all the ancillary businesses that surround them. And they're in different sectors. You have tech and you have manufacturing and you have, import, export, all these different industries that help cushion you or pad you or protect you when something negative occurs in the economy, which we all think that everything's going to keep going the way it is when we're doing it, but we all know that things will correct and, they have to correct. Cap rates cannot keep compressing, or else nobody can make any money. So we're going to have a correction, fairly soon. So when that occurs, we want to be relatively insulated. So that's kind of where we look for in an economic factor is kind of diversity in sectors of the economy. Population growth and popularity. There are some downsides to the popularity, though, that I didn't mention before. It makes it very competitive because you've seen it in the news. So I want to look to buy in Austin because I know people are going to be moving to Austin. Well, guess who else is going to be buying in Austin? Everybody else. And so it's going to compress the cap rate more than it would normally. So it's going to be more competitive. But that demand is going to allow you to drive rents higher. So it makes sense either way. It kind of works together work that out. But it is a little bit harder to win deals. You have more people bidding on deals, less likelihood of you actually winning the deal unless you have a strong relationship with the brokers. So that is a factor to take into consideration. So that what we were talking about is more primary metro areas, with the exception, I'd say, of Greenville is not really metro. Charleston is on the verge, but Charlotte, Atlanta, Jacksonville, Austin, those are all metro. You've heard of those, right? You know where those are. Everybody knows those. Those are my metro areas. So that's our main focus. Secondary, it's going to be, like I mentioned, Raleigh is borderline metro, but that's really a secondary. So is Greenville. Those are your secondary. And then tertiary is going to be more your rural markets, just towns you haven't heard of, like Warner Robins, Georgia, or, like I said, Fayetteville, North Carolina, or Fayetteville maybe better known because it's Camp Lejeune, but still would be considered a tertiary market, or Florence, South Carolina. Those are tertiary or third tier markets that we do not look in. Tertiary also, I consider some of the coastal markets to be tertiary. They have some nice houses, but there's really no industry there. It's more residential, more rural. But the upside of that is there's not as much demand or competition there. So you can get a good property, maybe a good cap rate or a good price per door, but it's going to be harder to push rent. So your value add or your ability to push rent is going to be much more difficult because there's not demand there like there is in the metro markets, if that makes sense. So I'll be glad to get some questions on this a little bit later. And then in the metro markets, what kind of demographics are you looking for? That really is talking about where people work and how much they make. And so you're always looking for 3 times what your asking rent is in income, and so that they will be able to afford that. So if your average rents, with all unit mixes combined are $1,300, you want their monthly income of the area that you are going to be marketing to, or people there, to be at least 3 times greater than what you're going to be asking as a safety net. And most of the time we're well above that. We don't have any issues there. So that is a factor to consider. And then the demographics, as far as, are they service industry, retail, travel, or, mostly consultants? What is in the sub-market of the metro? If you say, Charlotte, well, what about Noda? Or what about, South Charlotte? What is the demographic there? Where do people work? What is the income level in the submarket within the metro that you've already selected? So that is one of the main factors, or the major factors. And then once you've gotten into that, I'll go a little bit into underwriting, just because I'm touching on it today, working with Eric and Bob, and how to come up with a rent analysis. So once you're in the submarket, you want to look at where your rents are. So you've targeted what asset class you're looking for. You've targeted a state, you've targeted a metro area or a city, and then a submarket within that city. And then you have a deal that is in that, it's made it all the way through the filter and it's in that submarket. Now you need to find out whether you can make money on that. Is it underperforming from an expense standpoint? Is it underperforming from an income standpoint? So to do that, you're really looking at rent analysis. And I was trying to get set up before we got on this webinar so I could kind of show you what we were working on back there. We got all the screens set up, but I'm traveling. I don't have all my equipment, so we weren't able to do that. But basically what we're doing is drawing a kind of a small circle, 3 to 5 mile circle, really 3 miles around our property, pulling up what comps are in that property and then filtering them based on what is most like the property that we are looking at. That's going to, closest in vintage, closest in amenities, and see where the rent values are for that submarket and compare that to our property. So, I was just looking at a property and the market rents were right around 1,300. But this property was coming in, under 1,000 average, which is very, very low. And it was about 13 cents a square foot off of market. So that tells me that I can push rents. And so then I just need to figure out how much do I need to spend to get the rents there, what's going on, why aren't they achieving the rents? Is it poorly located? Because even though I've selected a city and or a state, a city, a submarket, within that submarket, your apartment may be hard to get to. We've had that. We have a property in Greenville that is a little bit off the beaten path. You can see it right from the highway, so it has good visibility. But if you're looking for it, you have to take a couple turns, and so it's not as accessible, and that can create some problems on traffic. And so, we're looking where, what is the reasoning behind this property lagging in market rents and what's causing that. So no issues with location, good there. Expenses were high. So that's telling me there's a problem with management. So that's probably why they're, underperforming in a rent analysis. And then that's not even considering what we call bad debt or write-offs, which of course is, people who are not paying rent. They are living in the property, they're not paying rent, and depending on the circumstances, you may or may not be able to evict them, so that bad debt number is growing. So I don't have that yet for that, but getting the comps, looking at the rent values, seeing how far we can push the property and what the cap rate is. We're also trying out a new software. We're doing a demo today, and some of you may have heard of this as Red IQ. It's kind of like an automated data scrubber from T12s and rent rolls. And then you can either use their model, your own model, or it generates a model. And we were playing with it just a little bit, and it was, spitting out some pretty neat numbers. You can put in, market cap, and it'll tell you how much you should be paying for the property based on the rent roll. And it's very quick. It just pulls the data down. Obviously you're going to want to go back and verify all that data, make sure it did it correctly, but it seems to be pretty sharp. And I will follow up with you on that as I am able to figure out if that's going to be something worthwhile. So it'll save some time on data entry, because I know how everybody loves to input data on a spreadsheet. So, all right, I'm going to go look at the questions right now. So let's see. I'll come back to this. All right, let me move this over to the side. All right, what tool services do you use to gauge market rents? Okay, great question. So we are using CoStar, but you can also use, oh my goodness, the CoStar has another, and I'm pulling it up. Give me one sec. I want to make sure I get this information correct to you, because CoStar kind of has a limited capacity in how you can search for properties, and so we want to get it into a geographical area. But CoStar is really the main tool. But you can get on any apartments.com is owned by CoStar. And so it's really the same data set, but it has a little bit more functionality in that you can set off geographical areas and kind of pull what is your true comp market. Because, I don't want to look at something, that's on the other side of town that really is not going to affect me. So apartments.com, and then we use apartments.com to get the list. And then we take that list and put it into CoStar, and that creates our comp list. And then we can get the data from there. And then as far as what we're looking for, we want to be at least third in the market from the rent ceiling. So market rents, we don't want to be the leader, right? So if the leader's 1,500, and then you've got someone else and we're 1,300, and the next lowest one is 1,200, but then we're second in the market, we don't want to be there. We want to be, third in the market. So we're not always pushing the envelope. So that's something we're looking for in those rent comps. So that is what we use, apartments.com and CoStar. So let me get rid of this. Do you work with an agent to look at comps, or do you use a website tool? So yeah, we use, again, apartments.com and CoStar. There's no it's not like single family, where you have MLS, different things, but CoStar is kind of like the comparative to MLS and gives you the comps on that. But it's great data. It is, pricey to use, but I think it's very valuable. If you don't have that, you can use apartments.com, but that data is not updated as often. And you're going to want to call to verify the data, because just because they're listing a market rent doesn't mean that's what they're achieving. And that's what we call loss to lease. Loss to lease is the market rent that you're asking, the difference between the market rent you're asking and the rent you're achieving. So that's loss to lease. We set our loss to lease at 0 because we're doing daily pricing. So we should have no loss to lease because we're always based on market. And that's based on an algorithm that looks at, what everybody's charging in the market. So we never have loss to lease. But I've seen it where they come out with a pro forma on a property and they're like, oh, we're going to achieve 1,500. And that's what they're advertising as. And they also may be giving some concessions on that, different things that you don't know about, that you don't see on the surface level of apartments.com. So get your main data, get that set up, and kind of high level qualify the deal, and then make phone calls to the property and just pretend like you're shopping it. I've been to properties and I just tell them, hey, we're looking to buy something right around the corner. I need to know kind of what you're looking for. And most of the time they're willing to help. All right. What amenities does your group typically look for when acquiring multifamily and implement once under management? So that really depends on the property, because not every property is going to demand granite or sub-market really. So that's going to depend on your comp set. So I'm going to look at all my comps, and if a comp is achieving greater rent than me and they do not have granite, then I'm not going to spend money to get granite. If everybody has granite and I don't have granite and I'm under market, then I'm going to add granite. Okay, if that makes sense. So it's based on what the market demands. And so I'm going to take a look at what everybody's expecting in the market when they're shopping, and somebody's online and they're looking for an apartment and they find, XYZ apartments over here, and they've got stainless appliances and granite, and this one does too. And then they come to me and I don't, I have white appliances and laminate tops. Then, I'm not going to be able to achieve as much rent. So it's based on the market. Some things that we implement that is different than other groups, maybe. Well, it's not different than other groups. Everybody's being creative. One thing I don't recommend is relying on, laundry income, like charging for washers and dryers and units. It's just the maintenance and everything is a wash. It's not enough to calculate, in my opinion. Same thing with valet trash. There's pros and cons to that. It's losing popularity, but I think there's I'm working on some creative ways to make that a little more viable, to save the property money. We use Gigafy, which is, it's fiber optics run. So we actually can sell the internet back to the tenants and be the provider there. And metering, water, individually metering water instead of, rubs or different things, or bill backs, different things like that. We've implemented, we have a property in South Carolina. Day one, we went in, added deadbolts to the mechanical closet because people were putting their stuff in there and, messing up filters and pipes and different things. Added the meters and added knobs to the cabinets because they didn't have knobs in their laminate cabinets. And so they were touching it with their wet hands and it was causing damage. So that was not part of our value add, if you will, of repaint and light fixtures. It was just us day one maximizing income and decreasing turn costs being the cost it takes to turn the unit when you need to lease it up again. And so we were cutting back on the damage. So those are a few things that we do. How does apartments.com compare with Bigger Pockets Insights feature defined market rents? We found that Bigger Pockets Insights can be helpful. Bigger Pockets Insights can be way off. So I've never used Bigger Pockets. It's because Bigger Pockets is great. We use it all the time. Brandon, if you're listening, we want to get on your podcast, but it's a more of a smaller scale. It's not institutional level multifamily, if that makes sense. And so it doesn't really work. It doesn't give us as accurate data as we would like. So I don't use it. CoStar is like the creme de la creme, or the highest that you can get, the best that you can get. So the data is pretty accurate, and it has, I can pull it up and see who owns it, when they bought it, how much they paid for it, and how much they're getting. What's the occupancy right now? And that's based off of their actual data, because they're using, either Yardi or Rent Matrix, different things like that to run the property. And that data, CoStar owns some of those companies, and that data goes straight into there. And so it's actual live data based on their financials. So it can be pretty accurate, but there's ways for them to skew that. So we still have to call the properties as well. CoStar. So CoStar is through, they have sales reps, just like many things. So the best way would be to go to CoStar.com and ask for a demo and have them show you. It is, it's institutional level. It's pricey. You'll have a little bit of sticker shock. We feel it's invaluable. All of our team members, even Melissa, who does all of our marketing, she uses CoStar because there's so much thing that they have, high def photos and, 3D unit walk photos and all kind of market data. I mean, it's endless. And I think some of you have seen us demo it on the show. So I definitely recommend it. Be sure to check that out. And I think, let me go to the chat and check that. Chat, where's my chat? There it is. So I wasn't showing screens of my target market. I know some of you have asked that. That's because I'm remote today, so I don't have all of my stuff. So apologize if it was a little more rustic than normal. And I see that Melissa's posted the YouTube video to Investor Nation. There are a specific number of thresholds that define primary, secondary, tertiary, a primary population of 1 million, et cetera. We don't really define it that way, if you will, as far as metro being a population level. And I'm sure there are some metrics out there that do that. In my mind, it's more like we talked about, popularity or well-knownness, how well known it is. And there's a reason for that too, not just on the purchase side, but on the investor side. So if we go out to our investors and we're saying, hey, we're looking at a property in Charlotte or Charlotte submarket or Atlanta submarket. Everybody knows those markets, right? Pretty much everybody in the U.S. has heard of Charlotte or Atlanta. Okay, so it's familiar in their minds, and so they understand it. They know it's a big city. There's obviously population growth, and so that's one main reason. If I say we're getting a deal in unknown South Dakota, they're going to have questions, and so they're going to be not as comfortable with that submarket because they just don't know anything about it. And hopefully that makes sense. So it's all about comfort level for our investors as well, because we are syndicators, and so we need to make sure everybody's comfortable, and we need to be able to prove the economic track. So on those metro areas, we're really talking about well-known metro areas. Somebody's mentioning Cleveland, Chicago, Gary, and Indiana. Those are metro, but they are declining in population or have a flatline population, some of those cities. And you're mentioning in this question that they have a lower entry point price, but there is a reason for that. And I'm not going to say that, it's going to always continue to decline. There may be a shift back to the Northeast, but right now in our current modern, history, that's not been the case, and they are not landlord friendly or don't tend to be. And you have a lot of increased costs in the Northeast. So your snow and ice and different things like that, your maintenance is higher. And so it's just much more difficult. But people do it all day. People live in apartments in north, south, east, west. They're not going to go vacant and be a ghost town in these cities. You just probably won't be able to be as aggressive with your rents. But that, again, that goes back to, that depends on your specific investment criteria. And that's the beauty of multifamily. I can do what I do and love it. And I have criteria that I set, and that's what I'm sharing with you. And, you could be on the other side and say, I just want to do single family, or I want to buy a duplex quad. Great. And you want to buy in secondary and tertiary because you can get it, a really good cap rate, 6-7 cap rate. We can't. Cap rates are compressing now in most of the markets we're buying to sub 4. It's just the nature of the beast. But as long as you can still underwrite it based on the market rents and make money. It is what it is. So one thing that we've always said that is a low cap rate means bigger return on my investment. So if I spend money on CapEx at a low cap rate and it increases rents by 200, and the lower cap rate means a bigger return on investment than it does at a high cap rate. So there's some pros and cons to that. But that's basically where we come in at. Let me just check. All right. That is all the questions. Wait, I think I see one more. Population numbers for growth, et cetera. I get those in CoStar, but there's also a place called City Data. So let me actually see if I can pull that up for you. And let's do City Data Charlotte. Yeah, and I'm going to share my screen. So that is not the one. Give me one sec. All right. So let me go back here. Let me share screen. Okay. Yeah, hopefully everybody can see that. All right. So this is giving you the demographics of Charlotte. So you can see right here, population in 2019. You're going to get some updated data from the census. So those are, as much as people complain about the census, we have to have it in our industry because it gives us this data. So here's all of your information, all your zip codes. Okay. It's got pretty much anything you can want in here. And then here's your map. This is really cool. So if I do change since 2000, it gives me a gradient map of the hot spots, if you will. And so I can kind of see where the growth is headed that way. And I can look at all different things in this list too. So you can pick whatever you want, population growth, anything you want in there, and it shows you where it's occurring on this map. So that's city data. That's free. You can type in city data, Charlotte, city data, Raleigh, city data, whatever. And that is what you'll get. So that's a great tool, free, that you can use. Okay, I got one question. I'm going to do something on my calculator real quick. Bear with me 1 second. Okay. So please explain how low cap rate means a higher return on your investment. I've always thought that this is the other way around. So that is a common misconception. And so everybody break out your calculators. Okay. So I'll give everybody a second. Pull it up on your computer. All right. So what I'm going to say is I'm going to raise rents by $200. I implemented a value add, and I'm going to raise rents by $200. So do 200 times 12. Okay. 200 times 12. All right. $2,400. That's my boost in NOI. It's one apartment. I'm just going to do it off one apartment. Boost on NOI of $2,400. Now I'm going to divide that by the cap rate to tell how much valuation that gave me. Okay. Divided by, let's do a cap rate of 5. So divided by 0.05. Okay. You came up with 48,000. Increase in valuation of the property. Because again, this is if you're going to sell at the same cap rate you bought it at 5 cap, you're going to sell it at 5 cap. Let's just keep it simple. You increase the value of the property by 48,000 by boosting the NOI by $2,400. Is everybody following me so far? Okay. Now I want you to go clear that out and go 200 times 12, 2,400. Now divide that times 0.04 cap rate. You increase the valuation of your property by $60,000, $20,000 more than at a 5 cap. That is how you can actually make more money with a low cap rate than you can with a higher cap rate, just return on the valuation of the property, because it's apples to apples, right? So, I mean, low cap rate equals more money when I sell, unless you have crazy expansion where it's going to expand back to, a 5 cap or expand one whole point. So hopefully that makes sense for everybody. Let me clear these out. Great questions so far. Oh yeah. And it's city-data.com, not city data. One word. So that'll help you. All right. I think we've got all the questions answered. And so I want to take you back real quick and make sure don't forget, coming up next is the Storage Investor Nation weekly webinar. That's a great industry if you're interested in that. It's basically multifamily without the pesky tenants. So, I'm just kidding. Without them tearing up your carpet and doing damage to drywall. So be sure to check that out right after this at 12 o'clock. So you got a little bit of time there, get some water, get a snack, and head that way. And then I want to pull up our next MFIN and just go. That's going to be coming up next week. And I apologize, I'm having to switch between screens because I only have one screen like a caveman here. I'm spoiled with my triple curved screens on a mount that I have at my house. So coming up next week, No Money Down, how to acquire your first multifamily asset without using your own money. Okay, so they're going to be talking about debunking the no money down myth, strategies for attracting capital to acquire your first property. Should you raise capital from family or friends? SEC rules and regulations surrounding selling these types of securities, and so much more. So be sure to check that out. That'll be next Tuesday, same bat time, same bat channel. So thanks again for joining me, and hope you have a great week. And as always, feel free to reach out via email and ask any questions that you weren't able to get to on this webinar, and hope you have a great rest of the day.